All right, I'm gonna erase the fibs, obviously, because can't give away the sauce here. You guys know the drill. Yo, you know what I just realized? I can put the before and after screenshot on the trading view screen. Stop playing. Come on now. Come on now. I don't know why I haven't done this before. This is dope. All right. I'm doing a whole structured stream, by the way, guys. I have an agenda and stuff. If you guys want to see personal growth, I have a fucking agenda and stuff. Probably already ruined it because people are already on the stream. No, I have. There we go. All right. I'll lock this thing. And get the visual order, bring this thing to the front. Boom. Ain't that great? Okay. I think we're live. You guys, we're live on YouTube, right? Yep, we are. Okay. Welcome back, y'all. So I'm going to keep this short and sweet. I know I haven't been streaming as often, but GDP report came out. There's tons of news coming out. People kind of got too focused on individual earnings releases, especially from NVIDIA, thinking that was a major driver of market action, which it was. As a market leader, it is important to see that the top seven, the Magnificent Seven, or now the Mag Eight, are performing well because that's one of the main drivers of market activity. But today, and I'm going to break down the GDP report that came out today. We're going to discuss the impact on markets. And if this is your first live stream, welcome. Make sure you guys hit the like and subscribe for incredible market information, live updates, and of course, daily live trading free of charge live on YouTube. All right, so let's talk about what the GDP report really came out. So, as you guys know, the Bureau of Labor Statistics releases the GDP report in multiple segments, three segments. One of them, oh, excuse me, one of them is an early estimate. The second one is kind of a revised estimate. And then you have the final GDP, which after all the data comes in, because the reason there's so many estimates and stuff is because they're still getting data in from some of the retailers, consumers, producers, manufacturers, and it takes time. So originally, in the first quarter of this year, the GDP number was at 1.6% in the first estimate. So everybody was thinking we grew at 1.6%. Not the best, but also not horrible. Today got revised down to 1.3%. So here's the deal. The reason the markets were bullish today, the reason that we bought, and we're kind of looking to take the market higher. The forecast was 1.2%. That was the revision because analysts have access to that data too. All the consumer data and the manufacturing data that's coming in, analysts get it as it's coming in. So they already knew that 1.6 number was going to get revised, and they were expecting it to be a little bit worse. So even though we revised it down, 1.3% growth is horrible. It's a significant slowdown in the growth of the economy compared to the fourth quarter of 2023. But compared to the expectations that traders and market analysts had, this is positive. You guys understand how, in the macro sense, big picture, reality, like the real economics of it, not good. Because we obviously did worse than we all expected. But from a reaction standpoint, which is what drives market action on a day-to-day basis, this is a relief. Okay, because whenever you beat expectations, typically that's bullish for stock markets due to that relief bounce. George, I can't remove it from the old one. I don't know what to do. Fuck it. I don't need the I don't need the pat on the back. I'll just I'll just give out free trades. Just you know, just sit here and just give it away for free. What platform are we trading? Okay, we'll talk about that later. All right, let's keep talking about the GDP report here. So, first quarter 2024, GDP increased by 1.3%. So if you kind of look at the fourth quarter of 2023, GDP growth was at 3.4%. 3.4%, really good. 1.3, you have to think about we have government budget deficits. We have the interest expense on all the debt that the Federal Reserve and the government have incurred from money printing. We have significant supply chain problems. We have, supply chain constraints between Russia's war, the Middle East, Iran, sanctions, China. 3.4% to 1.3. We need to grow at least 3% to grow out of our problems. And this is kind of an analogy for your personal life. My brother and I were having this convo yesterday about budgeting versus increasing your income or your earning potential. So how many $5 coffees would you have to save, to really be able to build some kind of substantial wealth? Like there is no amount of coffees you could save. I know what they say about the compounded interest and all these things. They didn't take into account fees, management fees, withdrawal fees, and taxes. Think about the headache of like trying to restrict yourself of a $5 kind of sacrifice versus drinking that coffee and going to make an extra $100 a day. You guys understand? So, big sort of wealth creation tip is don't ask yourself how you can save your way to greatness. You're never going to save your way to greatness. If your income is fixed, you can't budget. You can only budget yourself so much. So you have to increase your earning potential if you ever hope to make progress in your life. And so it's the same thing with the government. So yeah, we can keep trying to cut the budget and we can keep trying to sort of get spending under control. And we should, right? I'm not telling you guys to be reckless with your spending either. But GDP growth is sort of the only saving grace that we have in order to do something significant enough to actually make a difference. Okay? So the AI revolution hopefully is going to be that driver. We'll talk about that some other time. All right, let's talk about the slowdown. So biggest causes of the slowdown were consumer spending. We increased our imports. So instead of making more stuff and keeping things in-house, we started buying more stuff from overseas, which makes sense because the dollar is so strong right now, it takes less dollars to buy foreign stuff. Okay, because the dollar is so much stronger than, let's say, the yen. And so we can go there with $100 and it'll buy us $200 worth of stuff. So right now, a strong currency does help your imports, but it hurts your exports. And that's something that we need because you can't just buy, you also have to make money. So let's talk about how prices kind of inflation's still going up. Prices are still rising, but the rate of increase is decelerating, like it's slowing down. So prices aren't going up as fast as they were. That doesn't mean that, like, what we want to see is prices not going up no more and then starting to come down. We're not even there. But the best we can hope for is at least a deceleration in the rate of growth. Let's see. What else? Yeah, we'll do a little Q&A at the end in case you guys have any questions. So keep those off to the side. And then last thing before we get started, last reminder for today. I'm probably going to do a reminder at the end, so don't hold me on that one. But we hold a master class for day trading NASDAQ. This is what you guys see every day with these very accurate entries and sort of, kind of calling out these trades in advance. So if you're interested in learning a system that works, if you're interested in really just getting on track and starting to make money trading and taking your trading to the next level, this is the class for you. The link is in the description below, or you guys can head over to chartaddictsfx.com to reserve your spot. Okay? Tickets are only $500. If you guys show up to the webinars, there's a discount that gets sent. If you're a previous Chart Addicts member, you get a 50% off code. Go ahead and reach out to us. And if you need more information, there's plenty of real testimonials on the website that you guys can check out. At least just hear it from folks about some of the pros and cons of the class and get a more realistic feel of what it can do for you. All right, let's go through the rest of this GDP report. Let's get to it. So in case you guys are kind of more new to macroeconomics or economics in general, GDP is basically the size of the economy. So an economy is either shrinking or growing. Your household GDP is either growing or it's shrinking. Let's say you spent 5 grand that month, and then you made some money, and then you sold some stuff, and then you take all the total production, all the money that was made, that is your total GDP. And on a month-by-month basis, is your GDP growing or is it decreasing? And so we call it expansion versus contraction. So the economy right now is still expanding, but it's expanding at a smaller rate than we need. Just so you guys kind of get the hint here. We already covered that. GDP in the fourth quarter of last year was at 3.4%. We were doing pretty good. Let's take a look right here. You guys can see Q4 was at 3.4%, and then Q1, not good. Let's put this into historical context. The worst that we're going to see in a long time is COVID. No imports, no exports, nothing was going in and out. Travel was dead, commerce was dead, commercial enterprises were completely done, and then every business was closed. So we saw a 30% decline in GDP, which is unheard of. But then when things started to open back up, things started to normalize. And then we had a 30% increase in GDP that basically brought us back, I want to say to normal, but we recovered pretty quick. You guys remember the V-shaped recovery from COVID. It was pretty quick. And then we started to have more moderate growth of in between 3 to 5%, which is rock solid. That's how we made it out of the pandemic. All right. Then Biden took over. I'm just gonna throw this over. I'm just gonna throw this out there because 2021. Here's the issue. You guys hear the phrase Bidenomics. I think stupid people and informed people have a completely different definition of what they mean and what they hear when they hear Bidenomics. Stupid people will assume that all the economic problems that are happening today are because of some Biden policy, right? Because like the border and and things are going up and prices are so high, right? It's Bidenomics. That makes no fucking sense. We got out of a pandemic and we printed a shit ton of money, and the Fed was supposed to kind of reel some of that money out of the economy. They did not. Now they've done a pretty good job of keeping rates high and sort of trying to get us back to 2%. I actually think that they've been doing a great job. But Bidenomics refers to first, and this is how I see it, first is the mistake of printing money after we'd already recovered from COVID. So in 2021, Larry Summers, who was kind of the head of the economics department at Harvard, and he was the, I think, Treasury Secretary under Bush, and a few other high-ranking positions. The guy is one of the most reliable, sought-after people when getting advice from folks at the Treasury and the Fed. They'll reach out to Larry Summers. He's been through a lot. He was warning the Fed, or he was warning Biden, that if they continued to drop that stimulus package in 2021, when inflation was already at 5%, that it was going to start an inflation crisis, and not to print the money, not to give out more checks. We had already recovered. Why do we need more? So for me, Bidenomics referred to this overabundance in spending, which is money printing, because we don't have the money. So we have to borrow it from our future self and just take debt, IOU, right? You just put on a note, hey, I got me back. I got you back. You're talking to yourself. I'll pay you back later. And you just print the money. And then in the middle of an inflation crisis, while things are still picking back up and we're kind of normalizing. So Bidenomics, I think, led to inflation staying consistently higher for longer. because they did shit they weren't supposed to. Then in 2021, inflation peaked at, I believe, or 2021 or 2022, inflation peaked at 9%. That's when the Fed had to step in with the higher for longer policy, the end of the 14-year money printing era that we'd all kind of grew up in, and the start of a new era. This new quantitative tightening, high interest rates, end of the 14-year party era. That's where we're at. All right. So now you got to see GDP's completely died down. Stuff shit sucks. All right. Biden's. I'm sorry. I'm not gonna. No, Biden sucks. I'm gonna be myself. I'm gonna tell the truth. They'll be like, Roy, he's just a little bit older and he's just trying to do this. No, go watch his old stuff. It's even worse. His new stuff is just like, I have sympathy for the guy now because the people around him are using him. Go watch his old shit. The guy's a dirtbag and racist and was locking up people for life for crack. And his son did crack. Oh my God. All right. We'll get into it. Or maybe we won't. Let me just go ahead and wrap this up here. So real GDP, 1.3%, increase by so here's the main drivers in 2023. Consumer spending was up last year. Residential and non-residential fixed investments were up. State and local spending was up. Not sure that's necessarily a good thing. They kind of offset it by decreasing private inventory investments, imports, which okay, so we didn't import as much last year and we produced a lot more. People were spending. So GDP purchase price rose by 3%. That's significant. But I think that has to do with the strong dollar more than anything else. PCE, which is the kind of like the main measure of inflation for the Fed. So the expenditures of it's a more accurate than CPI because CPI is more of a survey taken by a basket of random goods. PCE is more about the expended the personal consumption expenditures, which are the things that we spend the most money on, like the things that we actually spend money on. So PCE rose by 3.3%. That's the current inflation rate, if you believe the government numbers for whatever that's worth. So excluding food and energy, core PCE, it rose by 3.6%. So food and energy prices kind of went down, but everything else, consumer goods, still 3.6%. Personal income is up. So there is wage inflation. People are getting paid more, but it's not keeping up with the increase in costs, at least for segments of the economy. Let me see. Disposable personal income is up by 5.3%. That's like spending money. That's money that you're not putting towards your bills and necessities. That's up by 5.3%, total of $266 billion. Real disposable personal income is up by 1.9%. Let me see. The personal savings rate is up by 3.8%. That one was interesting to me. Personal savings. People having cash in the bank, not living paycheck to paycheck, being able to afford a $40 or $400 emergency. So at the same time that the rate of inflation is starting to slow down, which is good, wage inflation is still high. I mean, people are getting paid. GDP not growing as fast as we need to, but it's not negative. We're not in that recession territory just yet. And then really importantly, the savings rate is up. Those actually seem to be some pretty good signs. Would you guys agree? I can't believe I was overcomplicating trading for so long. So am I going in again? No, I already entered again. Got such a beautiful entry. Oh my God. So do I want to go in again? Let me see. One more dip down, yeah. We get one more dip in into right here. We go ahead and put a alert right here, right at the wick. And then one more right in the middle of the zone. And then one on the break in case it wants to break out. Okay, alerts are set, so now we can continue going through the report. Are people asleep on YouTube? Yo, are you people awake? It's based on a strategy and parameters to take positions, not hope. I love that. Alfonso, you're redeeming yourself every day. All right. Working and listening to you in the background. Put something in the chat if you guys are alive. I know that, like, I used to go to econ classes all the time and fall asleep. Bitch, I'm not your econ teacher. All right. I'm a fucking savage. Did you guys see this trade? I don't you guys know we do this every day, so I don't sit here and talk myself up, and I'm not gonna. But since y'all won't do it for me, who the fuck else? If you don't support yourself, my baby, nobody's gonna do it for you. That's a piece of advice for y'all today. All right. So yes, I'm gonna gas myself up. It's not arrogance. If no one's gonna pat your back, motherfucker, someone's got to do it. What are you gonna do? Sit here and just be a fucking bum? No, I'm a legend. Okay. We these trades back to back have been insane the whole week. Let me just show. We called this thing out to the T. Like, who does this? Who puts up an imaginary box on a screen, guesses the exact entry, the exact turnaround, the exact retest, and now we're literally in that trade in real time. Like that happened. All right, hit that zone. Beautiful buy entry. Came up to the top of the range. All right, we waited for that third leg of the move. Third leg of the move coming in hot. Right, third leg of the move coming in hot, and then guess what? It's like fucking clockwork. It's like better than clockwork. I'm talking about Jacob and Co. I'm talking about a fucking, Richard Mill. I'm talking about clockwork, every gear moving in sync. Oh, here's an image that has all four of them. A little tour. All right, step one, step two, step three, step four. It's like one of those flip books. All right, that's legendary status. So yeah, I'm gonna talk myself up. Why are you bullish if the higher time frame is bearish? What higher time frame is bearish, Luke? What is the higher time frame? All right, let's finish off the GDP report. All of my alerts are set in case the market breaks the lows. So we'll get notified here. So savings rates up. Let's go ahead and so prices are slowing down. Personal incomes are up. Saving rates are up. So consumers are being more cautious. I think that's kind of my final takeaway. Nobody saves money, and even though they're making more money, unless they fear a downturn. Let me see. Corporate profits are up. Let me see. So really, like the total income that was generated by production in the economy was up, but corporate profits took a hit, probably because of just people dialing back on spending and inflation. Non-financial sectors got hit the worst. So banks and financial sector still making money. Everybody else is feeling that sort of pressure from the consumer demand taking a hit. Let me see the revisions to the GDP estimate.
That guy, the big stuff that the government good stuff. Exactly.
If you guys are watching this at home, keep in mind that there's two things that can happen here. We're expecting this. Another option is that if the market does break through for kind of a more violent breakdown, I'm going to re-enter at these same exact prices, 575 and 600. So even if the market does a very aggressive bleed through and I lose these first trades, the second one will make it back. Keep in mind that the entry here at the 580 level is a 4.7 to 1 R. Okay, now clearly we're going to be securing partials on the trade. If you're trading futures with same day expiries, then you'll probably have to close the whole trade somewhere in this area, but you'll still be able to pull out let's say like a 1-to-1 if the market makes it back inside the range. Let me erase this stuff. You'll still be able to pull out a 1-to-1 if the market makes it just enough back inside the range. Here's what it would take to hit a 2-to-1 and walk away. Just the previous high of that TP that we hit earlier. To get a 3-to-1, we just have to break the previous highs here of New York and damn near a 5-to-1 if we hold all the way. No doubt, Josh. Good to see you, brother. Okay, awesome. We're about to wrap up here with the GDP report. Just want to make sure that I'll let you guys know. So consumers are being cautious. We know this. Corporate profits are down. Typically not a good thing because when corporations lose money, what do you think they do? They get responsible? No, they fire people. They lay off because they suck. Imagine not being creative enough. Like, I understand that there's tough periods in a company culture, and that's why there has to be sort of a balance. I think everyone made the same mistake in 2020, including us, including all major corporations and small businesses. Things were going really well, and everyone was so excited, and there was so much excitement around, and money's flowing around, and crypto. You start to overhire. You're sort of expecting so much more volume that you bring on a huge team. And then things slow down, but you kind of don't have the heart to kind of get rid of that team and kind of bring things back to normal. The only person that shifted that narrative, that entire culture was Elon when he took over Twitter. And I think it went from like 100,000 employees down to 7,000. And I know it sounds harsh because a lot of people here have a job. And I'm going to tell you guys some advice. A corporation's job is to stay in business. Because if the ship sinks, you're all dead. Everyone's dead. So, like, yeah, they got to cut a department, or is the whole ship going to sink and everyone's done? It's a clear choice. And so I'm going to give you guys a piece of advice here, just from a practical standpoint. When a ship is sinking, you're either crew or you're cargo. Okay? So even if you have a job, but especially if you have a job, make sure you're crew. Make sure that you're instrumental to keeping the ship around so that they're going to throw you off at the first sign of trouble. But that's typically what happens when corporate profits go down is they have to lay off. If you're in a department that is not consequential or you are not particularly consequential at your job, it's done. Now, by the way, just a side note about that, you don't have to stand out at all. I'm not telling you you have to be the star player at all. You actually don't want to stand out. You guys just want to have that sort of, you know, a smooth enough experience so you can focus on trading and things outside your life. If you're just an average person, talking about just be ordinary, but you're consistent and you're reliable, that's rare. People are not reliable. People are not consistent. And when people say they're going to do something, most people don't do it. All right? You can just stay in the background and just win. Side note, letting you guys know. Because if corporations losing money and savings rates are up and things are kind of looking like we're going into not a recession, but a downturn in terms of activity, a stagnation, you're going to want to be preparing yourself in advance to make sure that you're, that you have your chips in order. All right. So about those. Wages and salaries are up. Total salaries and wages increased by 60 billion. The original estimate was 73 billion. So they revised it down to 58. So it's like, oh, everyone's getting paid more. There's wage inflation. Not as much as we think. Personal taxes increased by 27 billion. What the fuck? 58 billion increase in wage and salaries, but 27 billion in personal taxes. Okay. Contributions for social insurance up by 8.3 billion. So more money going to entitlement program. The latest data shows that consumer and federal spending, but higher investments in other areas for credit revision. Okay, change. Okay, so yeah, the tax contributions outweighed the increase in wages. And that's kind of affecting spending. That's why we saw a significant downturn in spending in the first quarter of this year. I mean, clearly, like, look, we have to take seasonality into consideration. After the holidays, who's really spending in January, February, right? People, you do all the stuff around the holidays. There's presents, there's travel, there's all this stuff, and usually around January, February, things slow down. It's natural. And then you have the spring break season, summer, and all these back to school and all, not back to school, but sort of colleges and everything else. So activity tends to pick back up in Q2, which is what I'm expecting to see here, which is a bit of an increase in Q2. We'll see. All right, let's see what else is there. Anything else worth talking about? Market impact. What do you see? Yeah, that's basically it. So slower GDP growth, mixed signals, uh, tons of market impact. What are we looking for later? We're going to be looking for the final GDP report. So this is the second revised estimate. So the final GDP report, I think it's released in about 20 days, if I'm not mistaken. So we'll check that out, see if the 1.6 or 1.3% number was more accurate. And we I'm going to sound like Jerome Powell. We're going to have to be data dependent. All right. I gave Jerome Powell so now we're basically done with the GDP report. Just gonna talk shit and do a Q&A in case you guys have questions. But truth be told, I gave Jerome Powell so much shit. Guys, remember I used to post memes about Jerome Powell? You guys remember I posted the meme with Jerome Powell with the blunt in his mouth when he was testifying? I photoshopped the blunt. Is it higher for longer? I gave him such a hard time because he lied. You guys remember when he said inflation was transitory? We went through this in the report. Look at this. This is not a chart of inflation, but I'm going to use the timeline here just to demonstrate a point. In 2020, we printed a shit ton of money. No, let's actually take this back 2 years. 2018, we were 10 years into the money printing cycle. So after the '08 financial crisis, we started the QE facilities, QE 1, 2, and 3, and we basically let that money sit. Things were kind of getting stimulated, and then we dropped interest rates down to basically 0%. So you could borrow for damn near, banks could borrow for free. So they would borrow from the Fed for free, loan it out to people for 2, 3% for mortgage rates, 4, 5% for personal loans. Crazy era. Inflation has started to peak up in 2018. So Jerome Powell gets up and says, look, I'm going to have to put my foot down. We're going to have to raise rates. This low interest rate thing was cool. Janet Yellen didn't have the well, I can't even say that. Is that sexist? That's not even sexist. It's a saying. She didn't have the balls to raise rates, even though things had already normalized under her. Like Bernanke had normalized, okay, because QE 1, 2, and 3 kind of happened under Bernanke, and then Yellen kind of took over slightly after. But where it was already done. Keeping interest rates at 0% for that long was unnecessary. Jerome Powell came in, has some sense, wants to raise rates. Market crushes him. Market crashes, I think, for 2 months straight after he raises rates. So the market's like, all right, Jerome's a pussy. He's not going to do it again. We just taught him a lesson. Does it again. Market crashes. Market crashes so deep, you have to change his entire mind. He caved and bent over and dropped rates again. Well, he didn't drop rates. He basically announced that he was no longer going to be raising rates. Then, 3, 4 months later, COVID hits and all that shit's out the window. Okay, we print an ungodly amount of money into the system. And it's not just the Fed printing money to give liquidity to banks. It is the Treasury Department physically sending out fake money, fake printed money that we just borrowed from ourselves and just handing it out like fucking candy. So inflation went through the roof. All right. And we're going, fuck, where was I going with this? I was using CPI. I was using this chart to explain CPI. Was I explaining Bernanke? What are we doing here? Uh, damn, I had a pretty good point I was trying to tie in between 2020 and 2021, but not sure where I was going with that. Damn, I kind of just spaced right there, ain't it? If you had $10,000 savings to your name in an account, what would you do with it? Curious to know. Uh, Gabby, let's do a call with, let's do another, let's actually, really good question. Let's make that the topic for the Saturday webinar. The Saturday NASDAQ webinar, free of charge for everybody. You guys can just register. We'll do we'll kind of do a breakdown. That will not be financial advice. So please do your own research and make sure that you guys consult a licensed financial professional before making any decisions for you. But I'll tell you what I would do. And keep in mind, depending on how old you are and what your goals are, this is going to change. If you're older in your life and you don't want to be like you're near retirement, you ain't sitting there risking your money like the young people on here who got time to make it back if we fuck up. And so we'll kind of talk about those and the differences between age, kind of that duration, how long you need the money, goals, priorities, etc. But really, crypto is my number one focus right now, just to kind of keep it short and sweet. Because for me, I'm looking, because I'm younger, I am looking for high risk, high reward. And there's nothing higher risk and higher reward than crypto, besides maybe day trading. Not even maybe, definitely day trading. But crypto is very straightforward. I'm putting $1,000 in 15 random names. Most of them will go down 50%, 80%. Cool. And a few of them will do 2x to 5x returns. So I'll make my money back. And then a few of them will do 20, 30x returns. And hopefully one of them does a 50 or 100x. And I turn $1,000 to 50K or 100K. And that would be cool. But I ain't going to do that in real estate. Said the 4 hour time frame is bearish. People, take the classes. All right. Take the classes. Basics of Trading 101. They even teach this in Baby Pips. I didn't even have to come here for this one. All right, let me chill. Let me chill. Find some value here. All right. Floor. Bing. Higher floor. Bing. Higher floor. All right. So by definition, not bearish. Now, obviously we have higher highs, and then lower high. So what happens when you still have higher highs, but the market is making lower highs? It's a range. Like by we're going to get very specific here. It's a wedge. That's what happens when you have lower highs and a flat floor. And then what happens in a wedge? That happens. Okay. All right, people. I gotta rock out. I'm getting phone calls and stuff. I'm pretty sure I missed a meeting. Maybe. Thank you guys for joining. Uh, oh my. Thank you guys for joining. I appreciate you guys for stopping by. Make sure to hit like and subscribe if you haven't already. That was the GDP report, start to finish. We'll do a little kind of like 4 or 5 minute snippet of this stream just to do the final review. And don't forget to sign up for the NAS 100 Masterclass. Link is in the description. Head over to chartaddictsfx.com. Live classes. Secure your seat June 14th. If you want to start making real money trading, this is for you. All right? If you want to be a jabroni, then keep doing what you're doing. All right? Take it easy. Happy and safe trading, y'all. Peace. All right, cool stuff. No, we gotta go over the basics of higher highs and higher lows, guys. That's what we're